In today's video, we cover the important topic of investor biases. It is the truism in sport that a good team is good at both offense and defense. Well, investors can learn a great deal from sports. That last bit of good defense applies to investors in spades, and tackling their own biases should be step number one of a good defense. In fact, investors leave a lot of free money on the table when they continue to operate with biases. By taking this one simple step of eliminating their biases, investors can add up to 4 percentage points to their returns. If you would like that, then please watch the video where we not only cover investor biases but also solutions to overcoming these biases. These solutions, like checklists, investing journals, value investing, and thesis antithesis, will not only help you avoid costly investing mistakes but are your first step towards becoming an extraordinary investor. These solutions help great investors improve their temperament and also their investment returns. So, to become better at investing, investors first need to identify their own emotional biases and replace them with sound processes. This video will go into all the emotional traps ordinary investors fall into. But first, we need to understand what a bias is. A bias is nothing but a shortcut formed by humans to save time over repetitive tasks. So then, surely a bias is a good thing as it saves time. Not entirely. When tasks which require careful thought are done automatically without thinking, a bias can be harmful. And this is what happens in investing. This happens because buying and selling are not an everyday activity, and so the ordinary investor has no expertise in it. Secondly, the rules that an ordinary investor uses are not data backed and turn out to be wrong more often than not. To fight the natural instincts and biases, investors need to adopt a 3-step process. First, they must have the ability to spot their own biases. This is obvious as you can only solve a problem if you recognize it in the first place. Next, they must make sure that they have in place a system where they are forced to view the information objectively. Anything less, and they can be sure that biases will creep into their decision-making system. Thirdly and finally, they must use strategies like checklists, rule-based investing, asset allocation, and investing journals to take advantage of other investor biases. By following this 3-pronged approach, investors will find that they do way better at investing than they may currently be doing. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their families. Investors must realize that economic policies of the government, macro events, as well as the next quarter earnings announcement of their favorite company is not in their hands. However, investors can control their own reaction to market events as also their own behavior. Also, information is freely available, so there is no advantage an investor can gain due to information arbitrage. One of the few advantages a retail investor still retains is the ability to control his temperament. Let us go through all the biases as well as a few strategies of how to deal with them. If you would like to make the most of this video, please try to find instances in your past life where you may have fallen prey to some of these biases. I am recommending this because when I listed out my own biases, it helped me improve tremendously as an investor. With that prelude out of the way, let's dive in. The first bias we are covering here is recency bias. This is a bias many investors have when they look at the recent performance of many products and only invest in those financial products where the performance has been excellent. If you catch yourself looking at your favorite stock returns over the last 6 months or your favorite mutual fund over the last 1 year, you have fallen prey to this bias. To overcome this bias, an investor needs to understand that short-term performance is merely noise and thus tells him nothing of the future. Rather, the recent outperformance of certain stocks or mutual funds have made them more expensive than they were 1 year ago. The next bias we are covering is anchoring bias. Anchoring bias is a bias where we rely very heavily on the first piece of information that we receive. Investors with this bias tend to disregard further pieces of information that they receive on the same stock or asset as irrelevant. However, logically, investors should give equal weightage to all the information that they receive and continuously improve their knowledge of the market or any security within it. There is a simple remedy investors can use to counter this bias. Investors can create a checklist of information for any new stock or security they are considering and decide only when all the information on the checklist is filled. If you would like to get a checklist, please message checklist. I will bring out a video on checklists where I will cover what types of information the investor needs to collect on these checklists. By creating checklists, investors give equal weightage to all the information and also delay their decision to a time when they are more informed. The third bias we are covering is the bandwagon effect. The bandwagon effect is the tendency of people to copy what the majority of people are doing. So, if a play is the talk of the town, anyone who has not seen it feels he is missing a good thing and goes to see it without understanding what it is about. However, this bias works against investors. The reason for this is simple. An item that becomes popular also has high demand, and high demand drives up prices. So the bandwagon effect causes investors to buy stocks and other securities after they have become expensive, a recipe for poor returns going forward. Investors can thus counter this bias by learning how to properly value stocks so that they don't buy securities for more than they are worth. If you would like to understand how to value stocks, please comment in the message box below value, and I will come out with a detailed video on valuation which covers much more than the PE ratio. After having analyzed over 5,000 stocks in India and over 7,000 stocks outside India, I have developed a customizable valuation template that can value different types of stocks. The next bias we are covering is the hindsight bias. An example of hindsight bias commonly occurs with spectators as they watch a game of cricket. While the game is going on, most spectators do not know how the game will end. However, as soon as the game ends, many spectators rush to explain why they knew that a particular side would win. This bias makes humans overconfident in their ability to predict events. This overconfidence can lead to poor investment decisions and needs to be curbed. The remedy for this is to keep an investing journal where you write down your rationale for buying a particular security. You can then refer to this journal after a few quarters or years to check how accurate your analysis was. The fifth bias we are covering in this video is loss aversion. Loss aversion is one of the most common human weaknesses. It stems from the fact that humans experience twice the pain from a loss than the pleasure they experience with a gain. This makes them loss averse. So, when faced with bad news, humans tend to bury their heads in the sand like an ostrich does when it sights danger. They reason that if they don't pay attention to it, the loss will simply disappear. However, this bias works against investors because many a times there is a genuine reason for a particular security not to do well. So investors who have this bias only look at the positive news and ignore all the negative news about the security. There is a simple yet effective way that great investors use to overcome this bias. It is called the antithesis. Great investors always create a thesis as well as an antithesis for buying a company. So, if they want to buy a stock like ITC, they might have a thesis that it is a quality franchise with a near monopoly position in many of the industries it operates in. It has a great dividend yield and so on. However, they will also list down the threats of higher taxes, government regulations against tobacco companies, and the unorganized players as the antithesis. The benefit of this is that great investors can be on the lookout for these points, and if any of the points covered in the antithesis start playing out, they can quickly make an exit from the stock. This also takes care of their loss aversion bias. If you want to know what a detailed antithesis looks like, please message Antithesis and I will cover a company in detail with a thesis as well as the antithesis. With that, we conclude our video on investor biases.